very briefly, this is how the presentation is going to be. Very briefly, we'll discuss how what the budget 22-23 has for all of us, and in that way, we are going to touch upon issues, very critical issues in budget making. And let us try to understand that when the budget is released, we as economic students, how are we going to approach the budget to understand what are the components of the budget. I saw the email. I think there was a prescribed reading of chapter number 2, economic survey. If some of you have not gone through it, I would highly recommend, because as students of economics, it's very, very important. So even if when you are at home and the budget is released, and if someone from your relatives, he knows, or your friends, they know that you are an economist, then the first question is that what do you think about the budget? And to answer that, what do you think about the budget? We need to understand, how do we read a budget? What are the major components of the budget, the fiscal indicators that are present here? And as Ashirvad pointed out, a very important question on why is budgeting important. So just as we individuals, as households, we make decisions, similarly the government makes decisions, and there is always a constraint which we call as a budget constraint. And it's very important to have a budget constraint, because it will give you a foresight on what you can do and how you can go about it, and what are your objectives. So if your objective is to, say, give boost to infrastructure sector, then how are you going to go about it? So which are the components of the budget where you can emphasize, so that your final objective of the government's policy is met. So very similar to the budget constraints that we have for as individuals or as households, a government also has a budget constraint. And we're going to briefly see how this budget looks like. How do we understand this budget at the outset? And then we go ahead and talk more about its implications, the implications of the numbers that are contained in the budget, and how our fiscal policy is intertwined with the various insights that the budget gives us. So let's get started. If you want to access union budget, the central government budget, so we are a federal system, and we have a central government and we have state governments, and both of them have their own revenue and expenditure powers. There are certain schemes that are run only by states. There are certain schemes which are combinedly run by central government and the state government. Similarly, there are some sources of revenue which are only for states. There are sources of revenue which are only for center, and some are shared. So we are here going to talk about only the central budget, central government's budget. You have to go on this website, indiabudget.gov.in, and get access to the budget. The budget website looks like this. And here, if you see, the first document that you as an economic student and as an explorer should take up is budget at a glance. And when you see budget at a glance, I will talk about it in detail. It has, broadly, it tells you what are the receipts. What are receipts? Means your revenues. What are your revenues? What are your expenditures? And then how much is the deficit? Means how much is how much are your revenues short of your expenditure? And you will arrange for that shortage from various sources. And broadly, we call that as fiscal deficit, or the borrowings of the government. So now, when you have your revenue side and your expenditure side, what are the details that you will find here? Lower, you have expenditure, sorry, you have expenditure profile, expenditure budget. This will give you ministry wise and sector wise details of the budget. And then lower, if you go, there are demands for grants of central government. What are demands for grants? So how does central government make a budget? Budget is made here in Ministry of Finance, Department of Economic Affairs, Budget Division. And before the budget making process starts somewhere in November of the previous year, and we call for inputs from various central government ministries. These inputs are in the form of what are the various expenditure requirements of the ministry, and for, say, for example, there is a Department of Revenue, so they can also, and similarly other departments who have financial powers, they can let us know what are the various sources of revenues that you are going to get. So expenditure and revenue estimates are sought from various central government ministries. They are brought in here, they are collated, and finally with a lot of deliberations and consultations with the stakeholders as in the industry experts, the field experts. Say, for example, if we are deciding on the, again, I'll take the example of infrastructure. If we are deciding on the infrastructure component of the budget, which schemes should be allotted, how much money, one is the input you get from the ministry. The other is that you meet the stakeholders and the market participants in that particular sector. And after a lot of deliberations, taking in their inputs, there are research organizations who are working in this particular sector, taking in their inputs. Finally, we collate and we come to the final numbers that we see in the budget. So this page, when you see, you get budget at a glance, which is a very important document. I would highly recommend all of you to please go and have a look at it. It's just 15 pages and no writing, only numbers, and very crisp, very detailed, very direct. Expenditure profile will give you the ministry wise details. Then you come to demand for grants, that will give you the further details, how much each ministry gave in under which head. And on the left hand side, if you see, after finance minister's speech, you would see a key to budget document. I think all of us can just read it just to be able to understand this more, because I'm just introducing you to this particular page, which is a wealth of information, and to wealth of information and a very good insight, as in to understand what the government is planning to do in the upcoming year. And below speech, the finance minister's speech, you have key to budget documents, and then you have budget highlights, all very fancy charts, and you can understand the key numbers of the budget. Then you have annual financial statement. In annual financial statement, you have further details of, in an accounting format, you have details of what are the revenue and expenditure side, and then you have memorandum explaining the provisions in the finance bill, the major changes that are brought about in the parliament, that's the finance bill. Then the statements of fiscal policy, a very important document here. This will give you a broad, again, as economic students, highly recommended, because this will give you a broad macroeconomic perspective of different sectors and how does the government think about the fiscal policy to be. For example, we had the FRBM Act in 2003. Last 2 years, we have been breaching the FRBM Act. In the last budget, it was announced that government is going to get an amendment to the FRBM Act in the picture, but it wasn't announced this year. Why? So you'll get that answer in this particular statement, that okay, in such an uncertain environment, the government is aware of its broad trajectory, where it wants to go, how it wants the fiscal policy to behave, but we don't want to commit to particular numbers because there is so much of uncertainty around. So all these questions that would come to a person's mind while reading the budget, you can get your answers in that statement of fiscal policy. And there are some more documents. Okay, so going ahead, let me just show you budget at a glance of the budget at a glance. If you see budget at a glance, the first table here, you have number one, revenue receipts. Okay, so let me just try to make you understand what are receipts and what are expenditure. Receipts will have components like revenue receipt and capital receipt. What are revenue receipt? Revenue receipt are again of two types. Either they can be tax receipts or non-tax receipts. Basically, there are no asset liability thing happening here. They are direct revenue of the government, and there is no loss of asset or an increase in liability when this money is brought into the government. So revenue receipt are either tax receipts or non-tax receipts. And capital receipts are the one where your assets, if these receipts get into the government, either your asset declines, that is, for example, disinvestment, you are selling off your own shares in some of your firms, some of your PSUs, or it can be where your liabilities increase. So if you are borrowing from the market, that will also come in capital receipt. But here in capital receipt, generally when if you read chapter number 2 economic survey, you will be able to understand that capital receipt also we generally try to say as in two types, as debt receipts, debt capital receipts and non-debt capital receipts. So for example, if you are selling off your PSU's shares and you're disinvesting, that is not adding on to your debt, that is not to be repaid in future, that is a money that is going to be with the government. Your assets are declining but your liabilities are not increasing, so that is a non-debt receipt. On the other hand, you have borrowings, which are debt receipts. Okay, so capital receipts, again, as I told you, two types, and if you add all of these, you get total receipts. But total receipts is kind of a misnomer, because total receipts also includes your borrowings. That is not a receipt. So actually what you do is you remove that borrowings and you just add your revenue receipt and your non-debt receipt, as in from the loans if you are getting, or from disinvestment you are getting, and that is the money that is actually coming to the government without any increase in debt. So that is your receipt side. And what is your expenditure side? Again, you can spend on revenue expenditure, uh, which is roughly around, which is a major proportion, roughly around 85%. uh, a longer trend has been more than 85% of the total expenditure has been revenue expenditure. And but this year's budget, there was a change. I will just talk about it. And so the total expenditure can be divided into revenue expenditure and capital expenditure. Revenue expenditure, major proportion, and it includes subsidies, defense expenditure, it includes your pensions, salaries. Okay, and capital expenditure, that is the part of the expenditure that will actually build up your more productive assets in the longer run. And the expenditure that you're doing on infrastructure development, that is the capital expenditure. So that's how you read it. You have the receipt side, and then below that you will get broadly expenditure numbers, and then you will minus the two and you will get your deficits. Now the deficits are also various kinds of deficits, but I would just like to first let's just see what is fiscal deficit. Fiscal deficit is the easiest, the first starting point, which says that uh, if if your expenditure, how much, by how much amount your expenditure is higher than your revenue which you are getting without creating any debt, means your borrowings you should not consider as revenue. So expenditure minus the revenue that you are getting, essentially what does this mean? This means the amount of borrowing that you have to do, and that is the fiscal deficit. But now it is also said that, for example, there is some amount of borrowing, so some amount of borrowing is also done to make the interest payments. So if you remove that part, if you remove the interest payments part, so okay, I'll try to make you understand this in detail. So you understood what is fiscal deficit? It is your expenditure minus the revenue that you got apart from the borrowing. So basically the amount of borrowing is your fiscal deficit. We know the amount of borrowing is fiscal deficit, but in that borrowing you may borrow to pay off your interest payments. Just remove that, and because interest payments is like a sunk cost, and we just want to remove it and see how much borrowing are we doing for uh, the annual expenditure, the dynamic expenditure in the economy. And that's the amount that we get as primary deficit. And revenue deficit is your revenue expenditure minus your revenue receipts. So that is pretty straightforward. But the numbers that we are concerned about are fiscal deficit and primary deficit. Okay, and here on the second table, we have a look at what are these revenue. So these receipt side, just the receipt side, what are the details of these receipt side? As I said, there is revenue receipt. Revenue receipt has two components. One is tax revenue and one is non-tax revenue. Let us first see the tax revenue, part number 1, tax revenue. Tax revenue has the gross tax. Okay, now gross tax means how much the center has received from its sources, but there are some taxes which it has to share with the states. So if you reduce the state's share, you get 1A, that is center's net tax revenue. So what is net tax? It is the gross tax that the center had received minus the state's share. Okay, this is part number one. The second component of revenue receipts is non-tax revenue. Now, non-tax revenue, apart from tax, what are the other sources from where government is getting without increasing any debt or reducing any liabilities? A lot of these. One is the loans it would have given; it's getting interest payments. One is the dividends and profits it's getting. So that's a major amount. And then some external grants it's getting, some borrowings from IMF, World Bank. So all that comes in, not borrowings, grants, okay, which we don't have to pay. Otherwise, it would not be a part of revenue receipt. If it is a borrowing, it will be a part of our capital receipt. So this is a non-tax revenue, which is not adding any debt, or it is not reducing any liability. Now come to the capital receipt side. Again, as I told you earlier, there is a non-debt receipt and there is a debt receipt. Non-debt receipt is a recovery of loans, disinvestment. What is debt receipt? This is plain simple borrowing by the government. And okay, so this is how you read the budget. It's not very difficult. All you need to do is just open the site and just have a look at it. So when we talk about fiscal deficit is the amount of borrowing that we are doing in this year. And say for the current year 21-22, the fiscal deficit, that is government plans to borrow 15.9 lakh crore. Here it is 1591089. This is everything is in rupee crore. So 15.9 lakh crore. And for the next year, government intends to borrow 16.6 lakh crores. What does this mean as a percentage of GDP? If you see fiscal numbers as a percentage of GDP, it's just more easier to make sense of the whole thing. So because in FRBM also, the as a percentage of GDP were the targets in FRBM. So it's generally in fiscal policy we look at numbers as a percentage of GDP. So when you see the union budget 22-23 numbers, you have here 6.9 percentage of GDP as FY22. FY22 means the ongoing year. FY22 number as 6.9% of GDP, and the next year the government has forecasted 6.4% of GDP. That was 16.9 lakh crore, and this year's 15 lakh crore is 6.9% of GDP. So now it's important that when a budget is released, these are the four numbers that we get to know. That is 2021 actuals, 21-22 budget estimate, 21-22 revised estimate, 22-23 budget estimate. So this means that if, for example, if you take the case of this year, 22-23 budget, okay, this year I will be projecting for my upcoming year, right? 22-23. So that is the budget estimate that I will be provided. I will also be revising the estimates that I had announced in my previous year. That is, I will get revised estimate of the previous year 21-22. I will also be freezing the estimates of the year previous to the last year. That is 2021 actuals. So this means that actually it takes around two full years to get the final numbers of the budget. This actual 2021 is the final frozen number, which you can say, okay, in 2021 the revenue receipts were 16.3 lakh crore. Other numbers are just estimates, they are just projections. Budget estimate is a rough projection. That's the path where we want to go. That's where we intend to go. Revised estimate is a more refiner projection. Okay, but this 21-22 actually will be frozen next year when we will get the actual number. I hope you understood this, because this is very important. If you have not, you can just ask again. So this year I am going to project for my 22-23 years budget estimate. I am also going to revise my last year, yani 21-22's estimates, and I call it as revised estimate. And I'm also going to freeze 2021's estimates that I call as actual estimates. So likewise, last year the budget had projected a 6.8% of GDP fiscal deficit. This year we increased it by 0.1 because we are going to revise last year's, we are going to refine last year's estimate. So we increased it by 0.1% of GDP, and it reached 6.9% of GDP. And next year's estimate, we are intending to do 6.4% of GDP. If you see all through, this is much, much higher than our FRBM targets of 3% of GDP. Okay, but why do we do that? Because India has, as I wrote here, as I've written here, India has consciously adopted a counter-cyclical fiscal policy. What is a counter-cyclical fiscal policy? For example, it's a crisis situation which was there in the last 2 years. In such a crisis situation, when y is equal to c plus I plus g plus x minus m, in such a crisis situation, when private consumption and private investment both are not performing. Why? Because everyone is scared, there is precautionary incentives, motives to save, because there's so much uncertainty. Private consumption is down, there was lockdown, there was mobility restriction, there was a pandemic happening, there was so much of health loss. So when, because of all these reasons, private consumption was not picking up, and investment was also suffering, because in such an uncertain environment, the private players, they become risk averse and they don't want to put in their money in the market. So when private investment is also suffering, then the other component is, and of course net exports were also suffering because all the borders were closed. The only option that is left with us was G, that is government expenditure. We need to boost the government expenditure to compensate for the loss in other components, and as a result, expecting that this would in turn boost our income, output in the economy, and as a result have multiplier effects, because when your output increases, your demand increases, again you're giving more money in the hands of the people. They're going to consume, and investment is going to consume, investment is going to increase, consumption is going to increase. As a result, again your output is going to increase. As a result, your C and I are again going to increase. So this chain of multiplier starts in, and that's how you know uh, an ideal fiscal policy in times of crisis should be. And that's why the government has also adopted a counter-cyclical fiscal policy. How are we going to finance, by the way, such high deficits, such high borrowings? Because they are going to add to our debt and our interest costs. This is a very valid concern, but what the government is kind of adopting a two-pronged approach to it. One is, in order to finance your fiscal deficit, you need to, first of all, you cannot cut down your expenditure. How do you reduce your borrowing? You can reduce your borrowing either by cutting down your expenditure or increasing your revenue. But you cannot cut down expenditure because of counter-cyclical fiscal policy. The economy demands that you need to step in and you need to compensate for the loss of C and I and NX. So you cannot cut down your expenditure. What you can do is you can increase your revenues. How do you increase your revenues? By taking so many structural steps, making the whole tax system tax friendly, bringing about a lot of tax administration and other reforms in the economy, so that people are they are not reluctant in paying taxes. Taxes flow in easily, one. And second is that obviously boosting your growth. If your output, that is the base on which you calculate your tax, increases, you are going to get higher revenues. So one, the emphasis has been on higher revenue collection through structural reforms and tax administration and policy reforms. So, for example, the corporate tax cut. Corporate tax cut, the first instance, the idea in the first instance would be that it is going to affect your revenues, but in a longer term, it is a more welcoming policy for the corporates. They'll be more easily they would give in taxes. They'll be more forthcoming in paying taxes, and it will be an incentive for other corporates to come and join the business. So one is revenue through the structural policies, and the other is revenue through boosting the income, boosting the output, GDP growth rate. And how are we planning to do that? That is through the capital expenditure. So as I told you, capital expenditure, you invest in infrastructure and you invest in productive assets. They are going to in turn boost your income, and they're going to have multiplier effects. We'll talk about capital expenditure in a bit. Okay, so this was how you read the budget. This is how you understand the budget. So where does the rupee, this year's budget, if you see, where does the rupee come from? In of the 1 rupee that the government is getting, 15 paisa is coming from corporation tax. Roughly it's 15% of the revenue. 15 paisa is coming from income tax, 5 paisa from customs, 7 paisa from union excise, 16 from GST, non-tax revenue, smaller proportion, 5 paisa. Non-debt capital receipt. What is non-debt capital receipt? Capital receipts which are not at the loss, not increasing your liabilities and not reducing your assets, like your disinvestment, only 2 paisa, and remaining a large chunk is coming as borrowing. How, where is your rupee going? Your rupee is going in a whole lot of things. I don't want to get into the details of it, but a lot of center schemes, a lot of the schemes that are shared between center and states, that is the centrally sponsored schemes, a lot of pensions, a lot of subsidies, defense, interest payment, a whole lot of things. Okay, so amidst all this, let's go on the next topic, that is how India's current fiscal policy is poised to deal with global challenges. With so much happening around, where do we stand? There are four key characteristics that I'm going to discuss about India's fiscal policy and the budget that was released. One is improved fiscal transparency and realistic revenue assumptions in the budget. So earlier, there were a lot of, you would have read in news that there was a lot of discussion on, apart from the entities that have been accounted for in the budget, the government is doing a lot of extra budgetary borrowings. There are a lot of extra budgetary resources the government is raising. What is extra budgetary? For example, a government's body is borrowing. It is not coming in the government account. So, for example, FCI, Food Corporation of India, very standard example. It is not coming in the government budget accounts, but it is ultimately, when FCI may not be able to pay it, it may be a debt burden for the government, right? But however, it is not included in the account. This we call as the extra budgetary borrowing. So, but of late we've seen that the budget has become very transparent fiscally, and you see a lot of these below the line expenditure items which were not a part of the budget coming above the line. Say, for example, you see extra budgetary borrowings of the government which were around 1.48 lakh crore in 2019-20, reduced to 1.2 lakh crore in 2021, to 750 crores in 21-22, and 22-23 there are no extra budgetary borrowings that have been budgeted. So we are enhancing transparencies. On the second hand, there are, when you are making a budget, there are a lot of assumptions. Like I told you, that we write to the ministries, they come up with inputs, their requirements, there are stakeholder discussions and deliberations. Ultimately, the budget has a lot of assumptions underlying it, and the assumptions in this year's budget, they are very conservative. I'll tell you how. These are two examples that I wanted to share. One is that the year 21-22, that is the ongoing year, first 3 quarters have a growth of 44% in taxes. Okay. But the budget has come out with the revised estimate. Revised estimate is the annual projection that the government thinks is it's going to get. So for 21-22, the annual projection estimates a 24% growth in taxes, when there has been a 44% growth already in the first 3 quarters. How can the whole year be a 24% growth? This is possible only if the last quarter has a contraction, and a huge contraction, 14%. So that is a very conservative assumption. If But now, since the global situation is so uncertain, and anything can happen, that is why it just probably makes sense. But still, it's a very, very conservative assumption. Having a 15% contraction of revenues in the last quarter, it has never happened, because generally last quarter has more revenues, because it's closer to the tax filing date and a tax submission date and all that. But so you see that our estimate shows a 24% growth in taxes, and uh, in all probability we must exceed it. Okay, so this means that we have a buffer. Means, if for example this Ukraine crisis, okay, we'll discuss how is this Ukraine crisis going to affect our fisc. It's going to be through various channels. Okay, it's going to affect our output, which in turn is going to affect our taxes, the direct taxes, means your personal income tax, your corporate tax. It's going to affect our excise duties. If the government, for example, the oil prices increase and the government does not want to pass on the entire burden to the consumers, government is going to cut its excise duties so that it shares a part of the oil price hike with the consumers, and as a result our excise duties collection will reduce, our imports will be affected. As a result, our customs collection will be impacted. So these are various channels through which our fiscal economy will be impacted. Now, if, for example, so the point that I'm trying to tell is that given all these conservative revenue assumptions, we are actually trying to account for if the situation becomes very, very bad, okay, and the revenue is really badly affected, even if it is contracted, still we are going to achieve our targets because our assumptions were very conservative to start with. Okay, so this gives us a buffer to deal with the uncertain global environment. Okay, the second example that I wanted to give, next year, the coming year, we are assuming a very low tax growth of 9.6%, and we are assuming a 11% GDP growth, nominal GDP growth, which by all standards is a very conservative assumption, because even IMF and even our economic survey, we had forecasted 8 to 8.5% growth of nominal. So how do you calculate real from nominal? 8. Though you go from the Fisher's route, but in day-to-day usage, you can just say that 8% your real growth, and say, for example, with such high inflation, 5% your inflation, you add both of them and you get 13%, which is your nominal GDP growth. So if we go by our assumptions, the estimates that were there in economic survey, the growth should be roughly around 13 to 14%, but the budget is based on a very, very conservative GDP growth figure, which is 11% growth. Also, the budget includes, if you see the excise duty number, it is a 15% reduction in excise. See this here. If you see here, 1E from 21-22, it was 3.94 lakh crore and it becomes 3.35 lakh crore. So that is roughly a 15% reduction in excise duties. Second aspect, so we were talking about India's current fiscal policy. How is it very strong and poised to deal with, how is it poised to deal with the global challenges? First thing, fiscal transparency and realistic revenue assumptions. It just instills your faith in the government's commitment to sound fiscal management, that the government will be able to do it, and the government is trying to do it. Then the second point that I want to talk about is calibrated fiscal policy response. Okay, a lot of countries, when pandemic hit us, lot of countries, they announced upfront packages. Okay, that okay, we are going to do a 10% of GDP stimulus, a 15% of GDP stimulus. That has not been the strategy that India has adopted. We have adopted a very step-by-step approach. Why? Because in such an uncertain environment, you don't know what's going to happen next, and you had a complete lockdown to start with. If, for example, you increase, so in that, for example, go back to March 2020 when there was complete lockdown, end March 2020 and April 2020, when there was a complete lockdown to start with, and you start giving people money, direct cash transfers, or you start boosting, pumping in money in sectors, what will they do with it when the economy is on hold actually? So we had a very different policy of not committing to a very large fiscal, a very, a pre-committed number that, okay, we are going to do this much. Instead, we did a very step-by-step approach. You see that in the last 2 years, there were series of packages that were introduced, and every package was addressing the requirement of that instance. For example, in March 2020, the package had 88% focus on food and livelihood. In May, June, we gradually started giving sectoral support, and also focused on the vulnerable section, liquidity support to the firms, the food livelihood. And as you progressed more in October, November, and even last year, you see that the emphasis has transited uh, from creating safety nets to actually boosting the recovery as the economy was opening up, to boosting the recovery by capital expenditure and focus in infrastructure, focus on consumption. So we have had a very calibrated approach, and I think that's the whole, that's a very responsible policy to have. Third part is that I want to talk about is capital expenditure. The emphasis, everyone, that's the talk of the town. The budget increased 35% capital expenditure, and the emphasis has been in infrastructure sectors. This capex-led strategy will also help manage debt. Why? Because to manage debt, there are three things you should do. One is, either you have to stop borrowing now, so that your debt is what? Debt is all borrowings accumulated. So it's a stock variable, accumulation of all the borrowings. So one is you manage your borrowings. Okay. The other is we cannot do that. Why? Because counter-cyclical fiscal policy, crisis, you cannot cut down on expenditure. Second is you manage your rate of interest, because rate of interest is the amount that you pay on the debt, and that is the interest payment, and that adds to your debt. But that also is not that much in your control, right? You can obviously, RBI can, or through other means, we can actually try to manage the bond yields, but that is not completely in our control. But what the third thing, it is in our control, and that is focus on growth. If your growth increases, your debt becomes sustainable. There is a debt sustainability equation which is talked about in last year's economic survey, volume 1, chapter 2. If anyone is interested, please go ahead and look at it. That gives you a framework to understand how the debt changes and how are these inputs important in the debt transition and the debt trajectory for a country. So here we come back to capital expenditure. So the idea is capital expenditure, through its multiplier effects, is going to increase the output in the economy, and once the output and the incomes increase, your debts will be sustainable. That is one part of the story. And second is that your productivity will increase, and it's going to be, it's going to be a spiral, and it's going to have impact on various sectors of the economy. Okay, and you see these trends. These are the quarterly capital expenditure trends during nationwide lockdown. It was very low, and once the economy opened up, it shot up, and it has been sustained, because we know that's the only way to go forward. And the last part that I want to talk about is cooperative fiscal federalism. Very briefly, in such a setup, the center is aware that we need to go ahead with the states, along with the states, and to rope in states. We know that, okay, if, for example, I am going to boost my capital expenditure, it's not enough. The states also need to do it. And how do you do that? By putting proper incentives in place, so that the states, they are required to, they ultimately end up doing it. Okay, so some of the steps that the center has taken: one, when the economy was hit by pandemic, the compensation cess that is provided to the states to compensate them for the loss in revenue due to the transition. So compensation cess is a levy that is collected when you are paying GST, and so the idea is that the states So when we transited to the GST model, it was thought about that the states they submitted that the states' revenues will be at loss. So to compensate them for the loss in revenues for the first 4 5 years, this compensation cess as a levy was introduced, and this is the amount of money that is given to the states to compensate for the loss in revenue if they are having compared to the previous model before GST, the multiple taxes that were there, okay, the sales tax and all. Now, this because of the pandemic, this compensation cess was affected, and the states were not able to get as much. So what the government did, the government made a special window. It borrowed on behalf of the states, and it passed it on to passed it on to the states as a loan. Okay, the interest will be paid by the government, but the loan amount will be repaid by the states in time to come as they recover from it. But this is very important, because if the states go to the market and they borrow, they will be charged, they will be given loan at a much higher interest as compared to the central government. So one is this GST compensation, and another thing is that for the last 2 years now, states also have their own FRLs. Fiscal, just like center has FRBM, state also have their legislations, fiscal responsibility legislations, and these borrowing ceilings, as per it, the state is also supposed to borrow only 3% of its GSDP. But because of the pandemic, the revenues were affected and the expenditure requirements were higher. So these borrowing ceilings for the states were increased for the last 2 years, and this year also it has increased. It is estimated to be at 4% of GSDP. Okay, and the last point is that there are special schemes. Okay, by the way, a part of these increased borrowing was linked to capital expenditure. Okay, so if you spend this much designated amount of capital expenditure, only then you can borrow. So putting incentives in proper place. And budget 22 also increased the funding under the scheme for financial assistance. This is a very interesting scheme where interest-free 50-year loans are being provided to the state governments by the central government for spending on capital expenditure. So a bouquet of things being done. So just to encourage capital expenditure from the state side. So all in all, we saw how we read a budget, what can we gain, what is the revenue side, expenditure side, how is fiscal deficit calculated, what is primary deficit. After all this, what relevance does it have? What is the fiscal deficit's primary object, fiscal policy's primary role in today's world for India amidst so much of uncertainty? In first point we discussed was that India first point we discussed was that India, the fiscal transparency and conservative revenue assumptions give a buffer to the budget, and we'll be able to achieve the estimates that we have projected. Second point we discussed was India has a calibrated fiscal policy. We didn't jump right away in the middle and say that we are going to do this much and that much. As the situation evolved, our response also evolved, and we changed our response. And the third point that we discussed was capital expenditure boost. And fourth was about the fiscal federalism, which means that the center and the state fiscal policies are rightly aligned to achieve its objective. Thank you so much.
Thank you, Gurvinder, for providing such an educational overview of the budget.
Thank you for having me here. It was great. I just hope that they've learned something.
After every class, we hope the same thing.
The same thing.
That's one, yeah.
Okay, great.
Okay, thank you.
Bye.
Bye.
See you.
Thank you.